So you're getting ready to file your tax return, and then all of a sudden you get slapped with a huge tax bill that you were not expecting. The tax year is already over, and your CPA is now telling you that there is nothing that you can do. But luckily, you decide to get on YouTube and watch this video, and maybe, just maybe, you will walk away today with a way to cut your tax bill. Hey, my name is Sherman the CPA, and today I want to give you some last-minute tax hacks that may help you pay less taxes. If you're new here, go ahead and subscribe to our channel. We have over 250 free videos here to help you save and make more money. So what do you have to lose? All right, so these tax hacks involves deferring your income, which will effectively lower the amount of taxes you have to pay today. Specifically, I am talking about deferring your income into tax advantage accounts like retirement accounts or health savings accounts. Now, the great thing about these accounts is that you have until April 15th of this year to contribute to these types of accounts for the last tax year. Which means if you are not using these accounts and you want to save on taxes, you can set them up now, contribute some money to it, and use those amounts you contributed as tax deductions when you file your tax return. So if you just got an enormous tax bill that you don't want to pay, you can take these steps as a last-minute measure to reduce it. In fact, some taxpayers wait until they estimate their tax bill to determine how much they will contribute to these types of accounts to cut their tax bill. With that said, I am going to discuss some of these accounts with you so that you can maximize your tax savings. All I ask for in return is for you to click the like button below and share this video to help it reach more people just like yourself. All right, tax hack number one, the HSA. This is my favorite tax account right now. An HSA or health savings account is a dedicated savings account for qualified health expenses. Now, here are 4 reasons why I love using HSAs. Number one, when I put my money in an HSA, I can use the amount I contribute as a tax deduction when I file my tax return. Number two, I can invest the money in my HSA, and as that money grows, it is growing tax-free. And then third, when I withdraw the money to pay for health-related expenses, it is also tax-free. And number 4, my favorite, I can withdraw money from my HSA at any time without paying any penalties, unlike retirement accounts that penalize you for withdrawing money before you reach a certain age. So here is an example of how an HSA saves you money on your taxes. Let's say you're married and your taxable income for the year is $100,000 after taking all of the tax deductions and tax credits you could find. Well, if you establish an HSA account and contribute the maximum amount of $7,200, you would lower your taxable income to $92,800. Since you will be in the 22% tax bracket here, this means you would save about $1,600 by contributing to your HSA account in taxes. And $1,600 saved each year would be worth over $290,000 in 30 years if you invested those savings and earned a 10% rate of return. And if you turn around and invest these $7,200 inside of your HSA, you would have over $1.3 million in 30 years with a 10% rate of return if you invested that amount each year. So basically, by contributing to an HSA, you are getting a tax deduction, your money is growing tax-free, and you pay 0 tax when you use it to pay for your health expenses. Now, in order to qualify for an HSA, you must have a high-deductible health insurance plan in order to use it. The IRS defines this as a health plan with a deductible of at least $1,400 for individuals or $2,800 for families. And if you are trying to use this for the tax year of 2021, then the maximum you can contribute as an individual is $3,600 or $7,200 if you have a married HSA plan. So you get twice the benefits if you are setting up an HSA for you and your spouse. Tax hack number 2, the traditional IRA. Now, this is by far the most common type of tax deferral account, but it gets the job done if you need to shave some money off of your tax bill. Now, you can contribute up to $6,000 to a traditional IRA or $7,000 if you are 50 or older, and use that amount as a tax deduction when you file your tax return. And if you are married, then you can set up a traditional IRA for you and your spouse and contribute a total of $12,000 or $14,000 if you are above the age of 50. Now, here is an example of how contributing to a traditional IRA can save you money on your tax bill. Let's say you and your spouse have a taxable income of $92,800 after taking all of your tax deductions. That will put you in the 22% tax bracket. And if you contribute a total of $12,000 to your IRA accounts, then you would save over $2,600 in taxes. That's more money that you can use to invest. And $2,600 invested each year would earn you about $45,000 in 30 years with a 10% rate of return. Plus the $12,000 you're contributing each year for 30 years, which if invested would earn you north of $2 million with the same rate of return. So as you can see here, these tax savings can compound into some huge returns when used correctly. And a lot of people think that these tax hacks provide negligible or small savings, but remember, everything compounds. And the fastest way to put money in your pockets is to reduce your tax bill. Tax hack number 3, 401k accounts. If you are an entrepreneur, then stick around because the next tax hack I have is for you. But this one is for employees who are fortunate enough to have a job with a 401k plan. A 401k plan is just a fancier version of a traditional IRA where your employer also contributes to your account. In addition, as an employee, you also have higher contribution limits. Instead of the $6,000 contribution limit you have with a traditional IRA, you can contribute up to $19,500 for the 2021 tax year. This is about 3 times the contribution limit of a traditional IRA, which also means you would have 3 times more tax savings here. So here is an example of how contributing to your employer's 401k plan can save you money on taxes. So let's say your taxable income is $80,000 after taking all tax deductions available to you. If you maxed out your 401k by contributing $19,500, then you would effectively lower your taxable income to $60,500. And if you are in the 22% tax bracket, then that would mean you would save about $4,300 in taxes. And if you save and invest $4,300 each year for 30 years, then you would have over $780,000 in return with a 10% rate of return. Plus the fact that the $19,500 you're contributing and investing would compound to over $3.5 million with the same rate of return. Maxing out your employer-sponsored 401k is one of the best ways to save on taxes and build wealth as an employee. Now, let's go ahead and talk about a tax hack that I like to use for entrepreneurs. Tax hack number 4, the solo 401k. A solo 401k is a one-participant 401k plan for self-employed individuals. And because self-employed individuals operate as both the employer and the employee, they get to benefit from higher contribution limits. And depending on your income from your business, you can contribute up to $58,000 to a solo 401k plan. So here is an example of how a solo 401k can lower your taxes as a business owner. So let's say you earned $200,000 in taxable income. If you created a solo 401k account and contributed $50,000 to it, then you would lower your taxable income to $150,000, which means if you are in the 24% tax bracket, you would save $12,000 on your taxes. And if you save and invest the $12,000 you save each year from your tax bill, then you would have over $2 million in 30 years with a 10% rate of return. Not to mention the $50,000 contribution you make each year would accumulate to over $9 million in 30 years, assuming the same rate of return. Again, another way to decrease your taxes and increase your wealth. Folks, I just provided you with 4 powerful tax hacks that can help you pay less taxes. If you are watching this video before April 15th, then you still have time to use these strategies. If not, keep this in mind for the next time you get a tax bill that is way more than you want to pay. Thank you for watching. I look forward to seeing you in the next episode.